the basics of call and put options as requested by this dude down here, Kosai19. So Kosai19 asks, can you please do a video about the basics of put and call options? And then he asks 1, 2, 3 questions. So let's answer these directly and just call it a day. Alright, so question 1 is, when do you want to use in the money or out the money strike prices? We're going to be using the SPY as an example because I got all the SPY stuff up anyway. So what he means is, let's take the SPY. Here we go. Here's the SPY. Are you bullish or bearish on the SPY? Great question. I'm always bearish on the SPY, so let's use put options. Actually, it's more intuitive to use call options. Alright, so everything I say with call options could be mirrored to put options. We're going to be using call options because it's just more intuitive to explain call options. So let's say we are bullish on the SPY. We think it's going to keep going up to all-time highs, which it's almost there, and we want to buy some call options on it. So the first thing you really got to ask yourself is, why do you want to buy call options? What's your goal? Are you trying to mimic holding a lot of shares of the SPY and then make money that way as a directional strategy? I think most not novices, I wouldn't say that. Most beginning options traders stick with this type of strategy. And as you get more advanced, you might go into more advanced strategies. You might stick with vanilla option strategies. But for the moment, let's just say your main goal of flat out buying call options is because you want to mimic having lots of shares of stock. So let's just take that assumption and then answer this question. What do we do? Do we buy the in the money or the out of the money call options? Well, let's take a look. If you don't know, in the money call options are call options where the strike price is lower than the current trading price. So it's going to be anything under 209.90. And out of the money is anything higher than 209.90. And then we have what's called at the money, which is basically the same as the current trading price. So the at the money strike price would be 210. So we have those three choices. So here's an example of out of the money because it's further away. Down here we got an example of in the money, 209, because it's down below our current price. Basically anything that's 209 or below is in the money, anything that's 210 or above is out of the money. And the question is, what do you want? Which one do you want? Well, a rule of thumb is that the out of the money strike prices will have lower delta. So if you look at the Greeks, they'll have lower delta, while in the money has higher delta. Alright? Now, why is that important? Well, because delta tells you how you're mimicking the stock. If your delta is 100, then that call option is mimicking the stock 100%. On the other hand, if your delta is only, let's say 14, which is what happens when you have a very far out of the money call option, you're only mimicking 14 shares of the SPY. So keep that in mind. But really, if you're going to play a directional play, you shouldn't care so much about in the money or out of the money. You should care about how much delta you get for the cost. So that's why you want to look at the ratio of delta per cost, and you're almost always going to find that buying lots of out of the money options is better than buying in the money in terms of price. So if you wanted to mimic 100 shares of the SPY, you would just buy about 25 of these, and then you could have 100 shares of the SPY for 25 times $9, which is going to be a lot cheaper than the very far in the money ones that have almost 100 delta but are very expensive. But remember, the strike price is only one thing you need to worry about when you decide on an option strategy. There's also the expiration date, which has to do with theta, how quickly the value of that option decays. And for me, if I was just going to go with a straight option play, generally I'm going to go with at the money or out of the money. And the reason being is that out the money has the highest gamma. So if my prediction, after all, we're making a prediction that the stock is going to move. If the stock actually starts to move, our gamma is going to come into play. And gamma is really important because it tells you how quickly delta changes. Delta actually does grow as the SPY goes upward. So eventually we're going to get to a delta where it's 100, and the faster we get there, the better. Now, the highest acceleration you're going to have, think of gamma as the acceleration of delta, the highest acceleration you're going to have is when gamma is at the highest. And you can find that's usually at the money, pretty close to at the money. And those are pretty cheap. This one's only $200, get a high gamma, decently high delta. If you wanted to mimic 100 shares of the stock, maybe you just buy 2 of these. For me, I don't really make pure directional plays that often. If I do, I'm either going to do a day trade where it's delta versus cost and I just buy a bunch of these, or I'm going to do a swing trade, and in that case I usually look at gamma, or I look at, you want the highest gamma, or I look at Vega. But Vega is completely different. It's a completely different strategy. I'll look at Vega if I think the volatility is going to increase and I think I'm going to go in a certain direction. Usually when I make a Vega trade, I'm either going to do it via a strangle or a ratio back spread. Those are much more complex than what we have to talk about today. So yeah, it wasn't a very good direct answer to your question. Which one do you want to use, in the money or out of the money? But for now, when you first start trading these directional plays, think of your time spent in that position. If it's going to be a day trade, go with delta versus cost. So go with out of the money. If it's going to be a swing trade, go with at the money, when gamma is the highest. I would avoid in the money for this type of trade, simply because it's going to be more expensive than these other two choices I'm giving you. In the money does have its uses, but if you're just going to play a directional play, I'd stay away from in the money just because they're too expensive. All right. After all, you have a thesis, and if your thesis is right, you're probably going to find that out of the money stock option is going to become in the money eventually, as you don't have to worry about starting with an in the money stock option. In addition, if you're not playing SPY, if you're playing something that's less popular, you're going to find it harder to sell your in the money stock option after it's profitable if you get too far away. I mean, if you're correct and the in the money goes way, way, way in the money, almost nobody is playing that. The open interest for that, which you can check here, the open interest for that goes way down. And then what happens is it's going to be harder to sell off. If you have only an open interest of 1, it's going to be really hard to sell this one. Okay. All right. So that's question 1. Again, in the money, you could probably avoid for short-term plays. For a day trade, you want to go without the money, out of the money, and if you're doing a swing trade, go with at the money. Question 2. If you have a specific target, is it good to use a strike price that's 50% of your target? Okay, so let's say you have a specific target for the SPY, and you want the SPY to hit, let's say, 215. You believe it's going to hit 215 soon, and the question is, do you use a strike price that's 50% of your target? 50% of the target would be way down at 100, so I think what he's asking is, okay, all right, let's say the strike price, okay, I get what he's asking. Let's say that our price target is actually 220, and here we are at 210. He's saying, should I buy an out of the money call option that's 215? In other words, halfway between what the stock is trading at now and what his price target is. My answer for that would be, go with a more complex strategy. It's not that more complex. All you have to do is add one more option to the strategy. Here's what I would do. I would use what's called a bull call spread. If you have a clear price target, use a bull call spread or bear call spread in the case of puts. And I do this very often for directional trades on gaps, because on area gaps, I know where the price target is, and I have a good idea to when I'm going to close that trade, what price target I'm going to hit, and then I'm going to take my profit at that price target. What I use is generally a spread here with the out of the money. Okay, so here's how the spread works. I'm just going to grab one with a high Vega. Don't worry about why, just we're going to look at one. Alright, so here's how it works. What you do is, besides buying in the money or at the money, here in this case it's at the money, let's just say you buy an at the money, and I think that's a pretty good rule of thumb here. You're going to buy an at-the-money call option, and then you're going to sell an out-of-the-money call option. What that does is theta hedges you. It reduces the theta so you're not seeing a lot of decay in that option strategy over time. But more importantly, your profit is maxed out when you hit that second call option, the sold call option strike price. So our profit's maxed out when we hit 230. Now this is not what we want in that example we just gave. We want one with the sold strike price being 220. So here's one. You buy the at the money July 210, which is where we are right now, and then you sell the out of the money 210 call. That means that we don't have to spend $500 on this strategy. We actually just spend $413 because we've sold one call option at $80. Now overall, we still are long delta, and if you wanted to, you could buy 3 of these and you would mimic 100 shares of the SPY, and your price target would be there, and your theta would be relatively low, only about $5. So what you got is an out of the money call option that's hedging your theta and that reduces the overall price of the option strategy, but it doesn't really hurt you in terms of profitability because you already know your price target is 220. So if the SPY goes above 220, you didn't plan on it going above 220 anyway. You're going to take a profit when it hit 220, and your max profit is basically around 220. So that's the answer to question number 2. In other words, if you have a price target, what you should be doing is you should be using that debit spread strategy with the sold put or sold call at the target, and the other one at the money. All right. Question 3, can you give an explanation of delta, i.e. how the value changes as it moves in and out of the money, and how you factor that into your decisions? All right, so how the value changes. Well, the value of an option doesn't change just based on delta alone. The value of an option is priced with stochastic differential equations because it's really a combination of multiple factors, and it's not as simple as delta, which is why I said when people first start out with options, they generally are only looking at directional plays and they're only looking at delta. As you get better with options, you're going to be looking at the other Greeks as well. But let's talk about delta. Yeah, I already talked about it briefly. How do you factor delta into your decisions? Well, you just think of it as a way to determine how many shares of stock you want to mimic. So let's say I'm playing a directional play on the SPY. I want to mimic 100 shares for a day trade because I think it's going to go up $1 and I'd like to make $100. Now all I do is I'd look at the delta, and let's say you choose just this first option, the delta is 40. I would buy 2 or 3 of those so that delta tops off or caps out at above, a little above $100 or 100 delta, so that we can mimic 100 shares of stock. Like I said, if you're going to be day trading, delta versus cost is important. But other than delta, we also have gamma, which changes delta. So it's a lot more complex than just delta. But that said, delta, when you make a strategy, if you want to use delta to determine how many you buy or what you buy, I would say don't use it to determine what you buy, but use it to determine how many you buy. So if you're going to use gamma to determine which one you buy, in this case you'd be buying this one, but you wanted to mimic 200 shares of the stock, well, go ahead and buy 5 of these and you'd have 200 shares of the SPY. So if the SPY moves up $1 in a day trade, you can sell all 5 of your calls and you'd come out on top $200 for that day. So that's it. Like I said, the bull call spread is very useful for gap trades. So let's say you're bearish on the SPY and you have this price target of 206. Well, first you'd have to use a trading system to determine that this is an actual gap that's going to be closing, which is called an area gap. And you can learn about that in the gap game plan. So if you ever want to learn how to gap trade, just Google, I don't know why it's so slow, just Google the gap game plan and you'll find my website, and I'll teach you how to trade these gaps. But again, for options on this, you're going to want to go with a call spread or a put spread and put that second one, put the sold one at that price target, which is for a gap trading system like this. I'll show you an example. So if you have a gap to be filled, like this area gap, you think the stock price is going to go downward, and you have that price target of 72, which is basically where the gap closes, then you would sell the put option, the out of the money put option at 72, and you'd buy an at the money put option at 74. So that would be how you determine which option strategy you use and exactly what your price target is in that case. So area gaps are great because they give you a price target right away. There's no thinking or research. You can tell right away that this area gap is going to close. So you just put your price target there. You find where to enter, and then from that debit spread, it's called a call spread or put spread here. I call it a debit spread. From that debit spread, you would actually, these two things work really well because from the area gap, you know where the gap is going to fill, and from the debit spread, you know how to max out, where your profit caps out. Because after all, one of the problems of these debit spreads is that it's not unlimited profit like a call option. A call option gives you unlimited profit potential, but a bull call spread here caps your potential. However, if you already have a price target, you know when you're to take a profit, your potential doesn't have to be unlimited, and you can max out that value of the option strategy because you have a price target. So those two work really well together. If this video is helpful, please like it and subscribe for more videos like this. And like COSI 19, if you have a question, put it down in the comment section below. I will get to it just like I did here. I'll answer your questions. So you basically got free advice here. Go for it.